Welcome. CPA Planet lessons help you get more points on your CPA exam. These lessons provide clear explanations from the student's perspective, visual learning, and we even try to make it interesting and entertaining. Enjoy the lessons and pass the CPA exam. We have several categories of items where you can have a gain or loss that is realized, but it's not recognized for tax purposes. There's some kind of exception or something. So we've got sales of personal assets. If you look at the chart here, types of non-recognition, losses are not taxed and gains are taxed. Okay, so again, the government wins. Normally when you've got these exception areas, in a lot of cases, the government will take the advantage. Wash sales, same thing. Losses are not taxed, means you can't take your loss, but gains are taxed. That's a wash sale. Related party sales, losses are not taxed, but gains are taxed. Like-kind exchanges, losses are not recognized, gains recognized only to the extent of boot. Okay? Divorce property, there's gain. Treasury capital stock, there's gain. Involuntary conversion, gain recognized only to the extent of boot received, meaning that the amount reinvested is less than the amount received as reimbursement. We'll talk about that. Installment sales, a portion of the overall gain is recognized as collected cash each year. Cash collected times gross profit contract price, divided by contract price. Sales of a principal residence, up to $250,000 or $500,000 gain is not recognized. There's rules about that. So we're going to cover all of these examples in detail. Okay, so just to give us an overview once again, here is a memory power image with all of the non-recognized gains and losses in one image. So you can remember this image, and that will really help you remember these. Not all the detailed rules are in the image, but you can remember what is a non-recognized gains or loss. So if you keep this image in your head and you see a wash sale on the test, you can remember the guy with the wash sale and say, oh yeah, that is a non-recognized gain. Like-kind exchange, installment sale, personal capital loss. It's all here in the image. So just remember this memory power image as an aid to your CPA studies in this area. Okay, non-recognized gain 1, involuntary conversions. Involuntary conversion of a property resulting in a realized gain is eligible for deferral. So, for example, involuntary conversion can be caused by loss, destruction, theft, seizure, condemnation. And then, so for example, a tree falls on your car and the insurance company pays you money. That's an involuntary conversion. Then you reinvest that in a new car, you don't have a gain. If they pay you $50,000 for your old Hyundai and you buy a new car that's only $10,000, you got $40,000 of boot, that's the excess of cash received over the amount reinvested, that $40,000 is taxable. Okay, now let's talk about basis. When the property is converted to a new property, tree hits a car, you get a new car, basis of the new property stays the same as the original one. Okay, so if your old Chevy Volt was worth $10,000, a tree falls on it, they give you $10,000 to buy a new car, and then you buy a new car, then your basis stays the same. You buy a new car for $8,000, what happens then? Okay, first of all, your basis is $8,000, and you also have a taxable gain of $2,000, which is taxed. Okay. The basis stays at $10,000. It doesn't go down, it only goes up. So basis stays at $10,000 even though you bought a new car for $8,000. So your car gets hit by a tree, your car is a basis of $10,000. Insurance company gives you $10,000, you buy a new car for $8,000, basis of the new car is still $10,000, and you have a $2,000 gain. Why do you have a $2,000 gain? You were given $10,000, you only spent $8,000. Continuing with involuntary conversions, we got a replacement time period. Replacement time period must be made within 2 years from the end of the tax year in which the gain is realized. So the replacement property must serve the same function in the business as the old property did. So replacement period is extended to 3 years if the conversion was a condemnation of business realty. Replacement period can also be extended with IRS permission. You ask the IRS, or if the area of the conversion is declared a disaster area. So if you had a February fire in your business, got the insurance money, and that's the year 2010, You then have until the end of 2012, because you got 2 years from the end of the tax year, 2 years from the end of 2010, you got 2011, 2012, you have till the end of 2012 to convert by the new item. Okay. The basis of the property required as a result of involuntary conversion is the same as the old property. So here's an example. Willie Mays' baseball bat was broken when he hit a home run. The bat has an adjusted basis of $2,000. Willie received $4,500 in insurance proceeds. Therefore, Willie realized a gain of $2,500 from the conversion. If Willie only spends $4,300, then now that's a realized gain of $2,500. If he spends $4,300 on a similar bat, then he will recognize $200 in gain. Realize $2,500, recognize $200. If he spends $4,500, how much will he recognize? $0. If he spends $2,000, just like the old bat, he will recognize $2,500. The adjusted basis of the new bat will be $2,000. That is $4,300, which is what he spent, minus $2,300. And that's $2,000. Okay. More involuntary conversions. Land owned by Bob the Plumber had an adjusted basis of $30,000. It was condemned by the state, and Bob the Plumber received similar property from the state to replace his condemned land. The basis of this new land is $30,000. Count Chocula owned a building with an adjusted basis of $400,000. The state condemned it and awarded him $450,000. Chocula bought a new building for $440,000. So, realized gain $50,000. Why is that? He was awarded $450,000. The basis of the old one was only $400,000. That's a realized gain of $50,000. Recognized gain $10,000. Why is that? Because he bought a new building for $440,000. He was given $450,000. The difference is $10,000. Amount realized $450,000. Adjusted basis was minus $400,000. Means realized gain $50,000. That's how we get that. Recognized gain equals $450,000 minus $440,000 equals $10,000. Gain realized but not recognized $40,000. You can back into that very easily. Cost of new building $440,000 less gain not recognized is $40,000, and the basis of the new building is $400,000. Non-recognized gain 1, involuntary conversions, loss recognized. Involuntary conversion rules apply to gains only. Losses are recognized. Here's an example. Phil had a factory with a cost basis of $340,000 that was destroyed by a fire. His insurance company paid him $330,000. Phil bought a new plant for $500,000. So he had a $10,000 loss because the insurance company only paid him $330,000 instead of $340,000. That loss is recognized. Okay, that's the loss. That's a recognized loss. The basis of the new factory is $500K because that's what he paid for it. Now, if he bought the new factory for $300,000, then he would have had a $30,000 gain and would have been boot because he received insurance cash more than what he paid, and that would be a recognized gain. Okay, let's move on to the next non-recognized gain, which is the sale of the principal residence. This is a popular one on the CPA exam. The taxpayer can exclude up to $250,000 of realized gain or $500,000 for married filing jointly. The exclusion can be used once every 2 years. The individual must have owned and resided in the residence for 2 of the previous 5 years. Okay. For married taxpayers, the options available if either spouse meets the ownership requirement or both spouses meet the use requirement. Neither spouse is ineligible for the exclusion by virtue of a sale or an exchange of residence. Okay, so the exclusion option may be prorated if the use and ownership tests are not met. The exclusion is based on the ratio of months used to 24 months and is a proportion of the total exclusion. The pro rata exclusion is allowed if the sale is due to a change in the place of employment, health, or unforeseen circumstances. So the basis in the new home is the cost. Okay, let's cover this non-recognized gain 3, Wash sales. A wash sale is a very simple concept. When you have stock, you'd like to take a loss for the calendar year. So what you do is you sell it at a loss and you take a loss, but you still want the stock. So as soon as the calendar year ends, you've got the loss, you buy it back again. So you're in the same net position, but because you buy it back for the same amount you sold it for, but you've got the capital loss. So the government doesn't allow this. Now, I want to make a point. If you think about this, there's really nothing wrong with doing this. You're not breaking any laws of taxation or physics or anything. You bought the stock at a certain price and it went down, so you got a loss. It's a real loss. So you sell it and make a loss, and that should be the end of it. If the government weren't being proactive about this, that would be the end of it. You got the loss, and then you're back to square one. You can do whatever you want with your money. You can buy it again. But the government feels in this situation, for whatever reason, they call it a wash sale, and so you're not allowed to take that loss. This also applies if you have the stock, you've got the loss, you haven't sold it yet, you buy the stock before you sell it. Again, the net result at the end of it, you end up with the same shares you had, and you got the loss. Government doesn't allow this. So look at the chart here. You can see the realized and recognized loss, and you can see the basis of the shares. So take some time to go through this, do some of your own examples, and you'll figure out the concept of wash sale is really easy. And any question you get, you'll be able to figure it out. This is a little chart showing you a couple examples.